Today we're talking about SoFi stock. The stock is down 75% year to date. They recently got some focus from regulators talking about regulating them on cryptocurrency trading and investigating kind of what they've done in the cryptocurrency markets with some of their customers. And this is one of the most popular retail stocks out there. And I don't think this stock is ever going to recover back to its highs of even $18, $19 a share, or get up to these insane $30, $28, $35, $32 price targets that people like Tom Nash and other YouTube gurus have been pushing it at. And I'm going to tell you exactly why. And I'm going to tell you 4 stocks that I would rather own instead of SoFi that have much better track records of long-term success. So the company currently has a market cap of $4.8 billion. It has a high short interest, 12.6%. And that's a lot of the hype behind the stock. People say it's going to recover. We're going to get a short squeeze just like a GameStop or an AMC or whatever. That's not real investing. And investing on those hopes and dreams is not going to work out long term. So what's happened in the news lately? The stock's getting pressured as odds of regulatory scrutiny rises, an analyst says. This article goes on to detail that crypto makes up an immaterial part of the company's business, so they don't get a lot of revenue from it. They do believe that this increases the odds that SoFi exits crypto entirely, and that regulators increase scrutiny on the banks. So that's going to hurt them in attracting some of these customers that they've been able to attract with some of their different lending options and different banking options. And what it could result in is SoFi being more heavily regulated with potential for incremental capital and liquidity requirements, which is going to hurt their business long term. And there's also the moratorium on student loan payments that's hurt SoFi stock. So maybe that's a catalyst when those things get turned around and people have to start paying their student loans again. Then that's going to help, SoFi, and maybe it jumps or whatever. But the point is, investing is about finding great companies at decent values that have long-term potential and good track records, right? And taking risks on stocks like SoFi and other ones like it is just going to result in a lot of pain, when I would rather take that money and invest it in high-quality businesses. And here are 4 other stocks: MasterCard, PayPal, Square, now it's called Block, and Visa. No, they're not all the same as SoFi, right? But my question would be, why would I want to take a risk on something like SoFi when it's so unproven, when I could own these businesses instead, right? And people will say, well, there's so much more upside in SoFi. It's only $4.8 billion market cap, right? But even after it's dropped, this stock is still so much more overvalued than these other companies. And I think they have a much more solid track record of success and higher likelihood of being around and being more profitable over the long run. So you can see over the last year, SoFi's down 76%, MasterCard's basically neutral, PayPal's down 58%, Square or Block's down 72%, and Visa is up 3.5%, right? And then look at these businesses long term, even with, some of this pain. For the last 5 years, MasterCard's up 127%. PayPal's still positive, up almost 4%, which isn't great. Square is up 28% and Visa's up 91%. So my question is, if PayPal and Square have been hurt so bad after the runs that they've been on and the historical success and some of the metrics that we're going to get into of their businesses, why would SoFi be any different? And why would that be a better investment case now than if you wanted exposure like SoFi going with a PayPal or a Square, a Block? I don't own any of these companies, to be clear. I'm just sharing different options and higher quality companies than SoFi, in my opinion. You get a dividend with MasterCard and Visa. You don't with PayPal and Block. That can be nice for overall returns as well. SoFi is still overvalued. If you look 3 years out, this is 3 years in the future based on analyst expectations, their non-GAAP price earnings multiple is 30, whereas MasterCard is 22, PayPal's 14, Block is 23, and Visa is 18. So why on earth would I own SoFi over the next 3 years with all of the risks that we're seeing in those types of companies when you can have much higher quality businesses for lower future price to earnings ratios? Now, in over the even shorter term, it's just terrible for SoFi because they're so unprofitable, right? Even if you want to look at it on a price to sales basis, it's about as expensive as PayPal and far more expensive than Square on a price to sales basis. I get it. The 3-year revenue CAGR is very high for SoFi, right? 53%, whereas MasterCard's only at 10, PayPal's at 16, Square's at 57, and Visa is at 8. But I don't think they're going to continue that revenue growth, and I don't see a close a near-term path to profitability for them. And let's just look at the profitability of these businesses. Sofi has a gross profit margin of 78%. MasterCard is showing 100, PayPal's at 43%, Square's at 32%, and Visa's at 97%, right? So Sofi looks pretty good on a profit margin basis. But let's look at net income. Net income is minus 28%. MasterCard's at 45, PayPal's at almost 9, Square's at negative 3, and Visa's at 51, right? And then we get to cash from operations, minus $6 billion in cash from operations. Everybody else is highly profitable on a cash from operations basis. If we look at net income, they had negative 165 million in June of 2021, then negative 93, then negative 97 in December, negative 93 in March of 2022, and then negative 101 million in June of 2022, and then in September, negative 74 million. And so they are estimated to continue improving and getting closer to profitability on a net income perspective. But still, by 2023, they're not expected to be net income positive. And so the question is what if something goes wrong? What if they have to pay more for growth? What if growth slows down? Then that changes their path to profitability and the stock is going to get crushed even more. So maybe the stock turns around. Maybe it becomes a lifetime success story. But you can only invest in so many of those major risky stocks. And if you have a portfolio full of stocks like that, low quality stocks, low quality, earnings that don't have a path to profitability right now, you're not going to have enough money invested in any single one of them for the one that might work out to really turn your portfolio around. Better approach would be to invest in high quality companies that maybe they don't have as much upside, right? They're not getting pushed by as many of these gurus and as much hype, but they're better long-term companies. And the fact of the matter is if we could get a 8 to 12%, 15% on the high side, which is awesome annual return, then you're going to be rich later on in life, right? Let's get away from some of these 100% years that people might be used to in 2020 and 2021. Let me know in the comments what you think of SoFi stock, and if you have any other hyped stocks that you want me to review.